Hi, I'm Pattu from freefincal. Freefincal was launched in May 2012, so that's roughly about 10 years of blogging, data analysis, research, reportage, blogging, whatever you want to call it. So I'll begin by first saying thank you to everyone who has wished me since morning today on YouTube, in the community page, in Ask and Ideas of Wealth, and over email and so on. We thank all our readers and viewers for their support and encouragement over all these years. That's the only reason the site has grown. So what I would like to do now is to share with you 10 financial lessons that I have learned over these years, many of these have come from questions that you have asked. So again, like I said, it is your ideas that push me to new areas of personal finance more often than not. So let's get started. The first is the most important lesson, I would say, in my view. Nothing works all the time. No strategy, no theme, no factor, no index, nothing will work at all times across all asset classes and markets. Sometimes growth investing will do better, sometimes value investing will do better, sometimes active investing will do better, sometimes passive investing will do better, sometimes Nifty Next 50 will do better, sometimes Nifty Next 50 will not do better. So nothing works all the time. So it's very, very important not to get fixated on one idea and say this is the best idea. No, we don't know. We have to take a chance and appreciate that our ideas will fail. Never ever cherry pick returns. Salespeople always cherry pick returns, but as investors, we must never cherry pick returns, but we must always cherry pick risk. Our portfolio must be able to handle the worst possible outcome from the past, at least from the past. Otherwise, it is going to be susceptible to even small problems, small crashes in future. So we must have a proper risk management strategy. Now these are 10-year SIP returns of Nifty Next 50. You can see it can be above 20% or below 5%. I mean, if I tell people that you should be ready for this 4% or for 2.5% or 3% return, people say no, you're looking at the wrong time. I mean, this is the most childish response I've ever seen. You don't know what your returns are going to be, because your sequence of risk, which I'll talk about again, is going to be one of these returns, or maybe even lesser than this or more than this. Nobody knows. So we must be ready for it. Our investment strategy must be beyond returns. Otherwise, we are leaving the fate of our money to luck. When it comes to personal finance, we must be able to think of dreadful things, of bad things. Only then we can prepare ourselves mentally for it. That's what I mean by macabre thinking. Now, I have said this many times. Equity market returns or capital market returns are clumped. It will never be regular. Sometimes it will give you a huge return. Sometimes it will give you huge losses, or sometimes nothing will happen. That is not compounding. I mean, that kind of behavior is not compounding. I don't know how people can say equity market. Many people will accept that equity markets have no guarantees. They will accept that stock market returns are not uniform, but they will say there's compounding. I don't know how that is. How those two ideas can be compatible. There is no compounding, there's only confounding in the capital markets, and we have to accept that and keep investing. When I write like this, people say I am against mutual funds and so on. No, I am not against mutual funds. I have made my financial independence because of mutual funds. Most of my net worth is in mutual funds today, equity mutual funds today, but that does not mean I will listen to whatever these industry people will say and take them seriously. I have to, my hard-earned money deserves much better respect than investing on hope. That is why I keep saying we need a proper risk mitigation strategy The simplest strategy over the years that I have found is just have a proper goal, have a diversified portfolio, have a suitable asset allocation, vary that asset allocation well before, that is reduce the equity asset allocation well before we reach the goal deadlines. That's it. That is all that is needed. I mean, it's not a, it's just common sense. Anybody with discipline can pull this off. So, now, regarding timing the market, everybody times the market. It's not like people who do SIP are not timing the market. Everybody is waiting for a good time in the market where you get 90%, 100% kind of returns. Those kind of returns don't come often. They come once in 10 years or 15 years or something like that. But you have to wait, whether you invest systematically or tactically, you have to wait for those bumper returns. If you don't wait for those bumper returns, then your returns are going to be poor. If you look at Sensex, I've done a video on this. The returns over 41 years is 16%, more than 16%. But half of that came from 3 good years, just 3 good years. 3 excellent years in 41 years, and one of them is a scam, the Harshad Mehta scam. 3 excellent years over 41 years is the chief contributor of 16% returns. That's why I keep saying this, that's not compounding, that's confounding. Anyway, so everybody times the market, everybody is waiting for that good time in the market. Now, we need money to make money. If people think that they can become wealthy by getting returns, they are just deluding themselves. That's the reason why I keep saying trading is a waste of time, because many of these people, their capital is very poor. Serious traders invest a lot of capital. These young people who look at those serious traders, they put in small amount of money and they think they will magically grow wealth out of it. No, it won't happen. Time is very important, but not as important as the money you invest, not as important as the principal. Returns are only tertiary, that's different. And I keep saying this, market crashes are scary, but we have seen earlier that huge upward movements and huge downward movements in the market, they occur within a short span of time. Something known as volatility bunching. But when the market doesn't move either way and just moves sideways, then it's very, very scary. You can lose a lot of money because you're losing time. If you lose time, you're lost it forever. If the market falls, it can quickly recover, but it may quickly recover. But if you lose 6 months time, like we have lost 6 months time now, more than 6 months time has gone, and that time is gone forever. You can't get it back. And I keep saying sequence of returns is the most important risk you have to understand in investing. You can look at any amount of graphs or do any amount of analysis, but what is your experience going to be after you start putting money? Nobody knows and nobody can predict it. We have to take action in real time. That's why we must be ready for everything. That's why I keep saying don't invest in hope because somebody said invest for a long time, everything will be alright. That's just bullshit. You have to take action in real time. Discipline is the most important attribute of a successful investor. It is not smartness, it is not intelligence. Even an investor with suboptimal choices, if they have the discipline, for example, investor holding 20 actively managed funds, even if they have such suboptimal choices, discipline, if they are disciplined and little bit of luck, they will be successful. Humility matters. Whatever we do, you can do all kind of analysis, make all kinds of reports. You can say I made to 20% return over 80 years or over now 70 years or whatever you want to call it, or even more than that, whatever you want to call it. You have got returns because the market has allowed you to get those returns. So luck plays a huge amount of role. I mean, it's okay for me to say I am lucky, but if other people say I am lucky, I will say they are losers. There's a big difference. You shouldn't call other people's success as attributed to luck. I can call my journey as luck, and I know it is luck. Luck plus discipline. That if you don't have that humility, that unless the market allows us to get the return, you will not get it. I think sooner or later we will fail. That is the reason why I keep saying that even if people ask us advice, even solicited advice can be harmful, because I am a victim of my experience, whether it is a good experience or a bad experience. My thought process is completely aligned due to those experiences. A new investor's journey can be completely different, and so who am I to advise them, even if they ask me for that advice? And every problem has got multiple solutions. There is no universally right or wrong method or technique or move or something. It is just that whatever you are doing, is it suitable for you or unsuitable for you? That is all that matters. And context is key. People forget about context. They keep asking, where should I invest? How should I save tax? They don't understand the context. Whether even the people who respond to them don't understand context. That's the problem. And just like that dialogue in Shawshank Redemption, salvation lies within. Our ability to protect us from the harm that we can cause to ourselves lies in the deep questions that we ask. Can we ask and answer questions like, what do we really want with respect to money management? Forget about life. I'm not asking deep questions like, why am I alive? What am I doing in this world? Those kind of questions are bizarre, too deep. I can't get into that. But at least with respect to the money we make, we must be able to answer at least focused questions. What am I going to do with the money? What are my goals? How am I going to achieve those goals? Where should I invest to achieve those goals? If you ask such questions and then start managing money, everything will be okay. But instead of that, what people do is, first they want to save tax, then they want to buy a house to save tax, and or they because of emotional needs, they forget about other crucial things like being emotional about retirement and being appreciating inflation and what it can do to you over time. So that's the reason why I say all the answers lie within. We are not looking within us, but we are looking outside and making decisions for us, looking at outside factors, and that never works out well. So that's all I have to say here. Once again, thank you for your support. Bye bye.